Think about when you're boarding an airplane.
Okay.
Who gets on the airplane first?
First class.
First class.
Every time.
And so you're sitting there with your ticket and you're probably in like zone 7 or 8. But, by the time your zone gets called, you're going to be one of the last ones to get on the flight and you're going to be sitting more towards the back. Well, but the idea though is by the time you get on the plane, all the best seats on the plane are already gone. Mm-hmm. Okay. Keeping that analogy in mind, as bad as it might be. But when you start looking at private equity investments, the best private equity investments are going to go to the people with the most money. You, as an average Joe investor, will never hear about them. You will never know about them. You will never know that they exist. And then it becomes, oh, I would have loved to have been invested in that. You never got the opportunity because you did not have enough money. Yeah. And the other thing, too, that's important to note is when you have these kind of gold star private equity investments, if you will, that go to the people with the most money first, they usually don't want people coming behind them on top of their investments. Because if those investments are really, really good, they don't want more people coming in to dwindle down the size of their investment. The more investors that you have in something, the less exclusive it becomes, the more ownership you have to split up, the more pieces of the pie you have to create in order to divvy up shares to go to all the different owners. So if you're inviting more people behind you, your shares at the top get more and more diluted, less valuable, so to speak, right?
The difference is between a public and a private company. So a public company, I can't talk all of a sudden, is one that is publicly traded. You can go to a stock exchange, right? Be it the NYSE or the NASDAQ or whatever, and you can go buy this because you want to and because you have enough money. It really is all there is to it. The real difference between the publicly traded companies and the private equity companies is the regulations are different.
Regulations and disclosure.
Yeah, and disclosure, exactly. So there are publicly traded companies have unbelievable amounts of regulation that they have to follow. Disclosure of financial statements, all kinds of stuff. They can't hide things legally. When they have hidden things legally, we usually get a news cycle that lasts for months, if not years.
And they will pay the price.
And yes, it is. The SEC will come down on them like God on Egypt. It is not a good thing, right? That's not true with private equity. It does not have that level of regulation or the disclosure.
Welcome back to another edition of the Retirement Planning Happy Hour. Eric Douglas, Chris Vaughn, where we discuss all of your favorite retirement and investment topics while we taste a nice little glass of bourbon. So today's topic, we're going to touch on kind of all things alternative investments.
Okay, I was wondering how we were going to name this because I know obviously what we're going to talk about, but I don't know what to call it.
Yeah, we'll figure out the name.
We're going to call it alternatives.
We'll figure out the name when we actually post it online for everyone to listen to. But just for our purposes, though, we'll start with kind of the label alternative investments. Right. And when you think about alternatives, so many people don't really truly understand what that means. And the way that we typically define it in our world is something that does not kind of fit neatly into the Morningstar style boxes.
Right.
Meaning they're not an equity, i.e. a stock, and it's not a bond, right?
Right.
So anything that's kind of outside of the traditional investment lane is usually defined in some way, shape, or form as an alternative. It's very much an alt,
use that phrase,
right?
Yeah.
And it's very much a catch-all term, and it describes kind of everything else that's available out there.
So to be clear, anything that is a stock or a bond or is based upon a stock or a bond, for example, mutual funds, exchange-traded funds, all that, those are not alternatives. We're talking about outside of that lane.
Correct, absolutely. Because those mutual funds and bonds, at the end of the day, their underlying holdings are individual securities,
bonds, right?
Yeah. So, but figured we'd talk about this for a couple different reasons, and we want to stick to really three main specific types of alternative investments. You could go down this rabbit hole, like real estate's another one. We're not going to talk about real estate in this episode. We've done it before. We'll do it again at some point. But we really want to talk about private equity investments. Those are getting a lot of press right now, and mainly because there's a lot of pressure to include private equity investments in things like 401ks and workplace retirement plans. We want to talk about crypto because crypto is, for whatever reason, always dominating headlines.
Right.
And then gold. Okay. And gold, silver, commodities.
Commodities in general, but I think gold is kind of the big one.
But really, gold's always the big one. That's the one that's always driving the headlines. That's what you hear the commercials about. And just wanted to give some thoughts on those three specific types of alternatives, mainly because you're seeing a lot of headlines right now. Also because We're in the middle. I don't want to say a correction because it's by no means anywhere close to a correction right now, but we hit all-time highs in the S&P 500 very recently, like this week or last week. And so it's amazing. You come down just a few percentage points. You get a tiny, tiny bit of a correction. It's not even a correction.
It's not a correction, right? It's just a
people,
downturn.
It's people probably taking profits
Yep.
at all-time highs, right? People selling some stocks to go, save some money for some Christmas gifts or something like that. I don't know.
And all of a sudden you hear the Chicken Little stories about the sky is falling,
and
right?
then everyone thinks that the sky is falling, and this happens all the time. And I've had to answer a few of these questions this week. Is now a good time to invest? Should I really be doing this? Should we wait until things settle down? Things are not really very volatile. Maybe things are increasing. Volatility is increasing a tiny, tiny bit, but in the grand scheme of things, I don't think this is going to register too terribly high on the Richter scale, so to speak. But all that being said, whenever there's any type of volatility in the S&P 500 or in the stock market in general, alternatives start to come back into the headlines. They
always make a showing, yeah.
And we start getting questions about them, and you start the commercials ramp up, and then we start getting questions. Well, is this a good time to invest in gold? Is this a good time to do crypto, or whatever the case may be? And so we wanted to dispel a few of those notions, a few of those ideas, and maybe give our take on why we do what we do. So that's kind of the setup for today's episode. Why don't you introduce the bourbon?
Well, since we're talking about alternatives, maybe an alternative to the normal way we do bourbon would be appropriate. What we're drinking today is Penelope Valencia. Penelope is somewhat of an alternative, if you will, because it is what we call a 4-grain. So remember, with bourbon, you have to have at least 51% of it is corn. And then there's always malted barley in it. And then it's either rye, traditionally, or wheat. And we call those wheaters. And they typically are a little bit softer mouthfeel, all that. They're super popular. A 4-grain is when you put all 4 of them in there. It's not normal to do wheat and the rye. The problem with wheaters is they don't have enough spice. The problem with the normal traditionals or the high rise, we did one of those a few weeks ago, sometimes it has too much spice. So when you put them all 4 together, you're trying to find that happy medium. And I will tell you, I've had a lot of 4-grain whiskeys over the years. They are hit and miss. There is no gray area on a 4-grain. It's either really good or really bad. I'm not going to mention names because there are quite a few 4-grains that I would love to see them be successful, and they're just not good. Penelope's an exception. Penelope, I've never had a Penelope that I didn't like, and there's quite a few expressions. This is, I will tell you that the story of how Penelope came to be is super cool.
I was going to say, because you went to an event.
I went to an event. This has been several years ago, 3 years ago, I guess.
Because that's where we got introduced to Penelope, and I've had a few. I've not had this bottle, but I've had a few different bottles of Penelope, and they've all been really good.
Well, I went to an event that was pre-scheduled with I hate to use the phrase, it's a big bourbon club that I'm a member of, because it's called Big Bourbon Club, right? And shout out to Steve. Big stands for bourbon is good. There's not a lot of creativity in that, but it's such an awesome group. And they do events here in town, and they will have master distillers, stuff like that, come in and talk. Well, they scheduled the 2 guys that started Penelope. They scheduled them for this event, and turns out this was on a Tuesday night. On Monday, they announced that they were selling Penelope, which was 5 years old.
Yeah.
They'd only been around for 5 years. They were selling it to MGP up in Southern Indiana for, it was like $110 million, right? You talk about the American success story of all time. This is the coolest American success story I've ever heard that I didn't read about in the textbook. Right? Super cool guys. But anyway, it's a neat story. I would encourage you to check that out. They have a lot of different expressions, and they do quite a few of them are limited runs. This is part of the Cooper series, which is one of the guy's sons is named Cooper. It's very family-based. And the Valencia version of it came out 3 years ago, and it was out of this world. And what they're doing is they're aging it in Valencia orange cask. Now, don't ask me how that works. I don't know, right? All I know is that's what it says on the bottle and on their website.
Something about Spain is on their bottle.
Yeah, it's Spanish Valencia oranges. Okay, so that's cool. I picked up a bottle, when this was out the first time, and everybody that I've ever shared that bottle with has said that's one of the best bourbons. It has an orange flavor in it, which you would think, orange and bourbon, that's not a good combination. It's a good combination. And they have re-released it due to popular demand. Unfortunately, every time I've seen it, it's limit one, and I've seen it once, which is why I only have the one bottle. This is an $80 bottle, so it is priced to intentionally kind of only go into the hands of people who really want it. You know, you go back to your normal 40 to 60 range is kind of where you want to live. They're intentionally moving it above that.
Yeah.
But
they're better than me. Yeah.
When I told several friends, hey, Valencia is re-released and they've got it at this big box local store, and that's the retail on it. Every one of them went up there to get it immediately, and they were sold out overnight. So it is out there. You will find it if you look, but not for very long. Couple 3 months probably, and it'll be gone. Yeah. This is 95 proof, so it's not something that you have to be very, very careful with how much you drink, like some of the 120s and 130 proofs. It's unfortunately just limited release. So that's what we're drinking today. You ready to talk about alternative investments as opposed to alternative bourbons?
Well, let's roll. So let's start off with private equity,
right.
Because private equity has been dominating a lot of headlines lately. Because, like I said earlier, the push to include private equity investments and private equity funds into platforms like 401ks, 403bs, workplace retirement plans to make them a little bit more broadly available to the investing public.
And this is something that the Trump administration has been pushing to get this out there where people do have access to it.
And on the surface, it sounds appealing.
Yeah, sure.
Like so many things in life. When you say it out loud and you give the reasons for wanting to include it, I want to be inclusive. I want to include more people. I want more people to benefit from the opportunity to invest in, like, usually pre-IPO companies, companies that are still listed as private. They haven't gone public yet, trying to get in early on some big-time investments. Imagine getting into things like Facebook pre-IPO and how much money you could have made, right? And that's the way that these things are sold. Now, along those lines, private equity deals come with a lot of other risks.
Okay, so before you go down that road, let's make sure that we define for the people who do not know the difference. The difference is between a public and a private company, right? So a public company, I can't talk all of a sudden, is one that is publicly traded. You can go to a stock exchange, right? Be it the NYSE or the NASDAQ or whatever, and you can go buy this because you want to and because you have enough money. It really is all there is to it. The real difference between the publicly traded companies and the private equity companies is the regulations are different.
Regulations and disclosure.
Yeah, and disclosure, exactly. So there are publicly traded companies have unbelievable amounts of regulation that they have to follow. Disclosure of financial statements, all kinds of stuff. They can't hide things legally, right? When they have hidden things legally, we usually get a news cycle that lasts for months, if not years.
And they will pay the price.
And yes, it is. The SEC will come down on them like God on Egypt. It is not a good thing, right? That's not true with private equity. It does not have that level of regulation or the disclosure. So now that we've kind of made sure everybody knows that, let's talk about the pros and cons of investing in private equity.
Well, I'll open it up to you. What would you think the biggest pros are?
The potential upside.
Yeah.
You just said it a minute ago. How would you have liked to have bought Facebook or Meta or whatever it is now? How would you have liked to have bought that before the IPO, the initial public offering, when I could have got it on the cheap, and then it explodes when everybody's out there? And we could name 100 companies that are well known that if we had bought it, I think Facebook opened at like $35. Remember that? It was some
when it
crazy
first
number,
came out,
and it dropped to 20 like overnight, and everybody went, "Uh-oh, no, you should have been buying that," right? We all know lots of companies that would have been unbelievable investments had you gotten in while they were still private equity, and that's the real draw to it. That's why you would want to do it, because you can make so much money off a moderately small investment. That's the attraction.
And those stories that you hear about always come in hindsight.
Yeah, it's that Monday morning quarterback.
And hindsight's always 20/20, right? Like, oh, I could have, I should have, and I knew I should have, and I wanted to do it, but I just didn't. Well, you hear that about the Facebooks and the Apples and the big IPOs, right? So many other private equity types of deals falter.
Yeah.
You don't hear about those. Right. And the people that are invested heavily in some of these other private equity investments, you don't hear about the ones that fail because the ones that are invested are not going to go boasting about their losses, right? But inherently, when you are investing in these types of companies, there's quite a bit of additional layers of risk that you have to incur in order to have a successful investment, if you will, however you want to define successful. But ultimately, ideally, I think most people want to make money at the end of the day. But in order to do that, I'm
not doing this to lose,
exactly.
Right?
But at the end of the day, in order to have one of those private equity types of deals become a success, you have to invest your money in a way that it's going to be tied up. You're not going to have liquidity. You're not going to have access to it. And it can take a long time for these things to bear fruit.
Exactly right.
It can take a very long time. And so one thing we always talk with clients when they start hearing about some of these private equity deals or alternative types of investments is understanding the lockup periods and how long your money is going to be tied up, because these are very, very illiquid investments. Yeah. The idea of trying to include these funds within like a 401k or a 403b is inherently, obviously you're trying to make these investments available to the masses, but the masses don't probably understand the inherent risks associated with these types of investments.
I think you're absolutely right. I'll add a layer to it. They can't stomach those risks either. This is one of those where traditionally with private equity, you have people that have some fairly serious investable assets.
Venture capital,
exactly. We're not talking about the millionaire next door. Yeah. Right. We're talking about people with multiple millions, right? The trust funds, the private single family offices, and there's some crazy money involved. Now, they can afford to get into these kind of things, and frequently do, because they can afford the loss, right? It's not just that they understand the risk. It's they can afford the loss. And to your point, many of these take years before they're ever profitable. Many of them never are profitable, and you lose everything. When you have people that have that level of investable assets, they can afford to take those kind of risks. And you say, well, the rich get richer. Yeah, because they can afford to lose. Joe Average out there like us, if you take on that kind of investment and it doesn't go well, it can be catastrophic. Whereas to the group that has $100 million to work with, they can take that hit.
It can be a rounding error.
They're still okay.
They might even laugh about it, right?
Yeah, exactly.
Whereas average Joe investor, not only can they possibly stomach the loss, but they probably can't stomach the volatility of some of these types of investments, because these can be extremely, extremely volatile. Because to your point, not everything is as open, not everything is as regulated and disclosed out in the open, and so you can get thrown some curveballs just kind of out of nowhere.
I just thought of an absurd analogy. We've all said this for many years. If you want to know what the market looks like, and I've heard you add one to it that I love, I use this with clients all the time. You've got a mountain climber going up a mountain with a yo-yo, right? Mm-hmm. If you are looking at it from a long way away, you just see that edge of the mountain going up. If you get a little bit closer, you see the mountain climber who's going up and down a little bit because there's crevasses and big rocks they got to climb over and all that kind of stuff. But if you watch the yo-yo, you'll get sick to your stomach. Mm-hmm. This kind of thing is the same guy. It's the mountain climber going up the mountain with a yo-yo, but he's on a pogo stick and he's doing yo-yo tricks. Yeah. Right? It's just, if you can imagine that. The volatility here is so off the scale in many cases. The average investor can't stomach it, right? And then you pointed out something else. There's a liquidity issue with these types of investments almost every time. So when we talk about liquidity, it's the ability to get out of the investment and move into something else, be it a cash position, that's the definition of liquidity, or just to a different security. We've seen this too many times where people have gotten into private equity, but they don't have the resources to stomach the loss. And what happens is they are truly stuck. And we've seen people that, their advisors have put them in this, and money's gone because the company didn't do well. And I think that's probably the biggest concern that we have with the concept of putting private equity into 401ks, where the average Joe out there who doesn't know how investments work has an access to this without understanding the risk. What the typical person does, if they don't have a professional guiding them, they look at their 401k options and they say, oh, look how big this one's been up over the last 2 years or 3 years or maybe shorter than that. And they don't realize the risk that's associated with it. It could have easily gone down that much and might. And they don't see that part. And that's what worries me about putting that kind of investment into a 401k.
Yep. One other thing about that I really want to hammer home as it goes to kind of average Joe investor, the Main Street investor. And I would imagine that's probably for the most part who would be listening to our podcast.
Sure.
That's for the most part, those are our clients, right? And those are the people we service, and we love it, right? We love working with those folks. But think about when you're boarding an airplane.
Okay.
Who gets on the airplane first?
First class.
First class.
Every time.
Maybe wheelchairs or
veterans
or whatever, but let's just take all that out, right?
Yeah.
But the people that get on the airplane first, the people that are sitting in first class, people that get on next, the people that are in like economy plus or economy comfort or business class
or whatever they call it, right?
Whatever the case may be. And so you're sitting there with your ticket and you're probably in like zone 7 or 8. They have that many zones now. It's kind of ridiculous when you're boarding the flight. But by the time your zone gets called, you're going to be one of the last ones to get on the flight. And you're going to be sitting more towards the back,
right?
Which is fine. Hey, that's where I'm at most of the time
because I booked my seat. I'm okay with that, but there's another part to it.
Yeah, well, but the idea though is by the time you get on the plane, all the best seats on the plane are already gone. Okay, so using that, keeping that analogy in mind, as bad as it might be, but when you start looking at private equity investments, the best private equity investments are going to go to the people with the most money. You, as an average Joe investor, will never hear about them. You will never know about them. You will never know that they exist until, if and when, maybe they become in some big IPO name, right? And then it becomes, oh, I would have loved to have been invested in that. You never got the opportunity because you did not have enough money. Yeah. And the other thing, too, that's important to note is when you have these kind of gold star private equity investments, if you will, that go to the people with the most money first, they usually don't want people coming behind them on top of their investments. Because if those investments are really, really good, they don't want more people coming in to dwindle down the size of their investment to what's the word I'm totally missing on?
I know what you're trying to say, and it starts with a D. I'm losing my mind.
Dilution.
Dilution.
They're diluting their shares, right? Because the value of their shares is the more investors that you have in something, the less exclusive it becomes, the more ownership you have to split up, the more pieces of the pie you have to create in order to divvy up shares to go to all the different owners. So if you're inviting more people behind you, your shares at the top get more and more diluted, less valuable, so to speak, right? First investors don't want that. If it's a prime opportunity and they really believe it, they will put their money behind those ideas, and they want to limit access.
They
to
want
other
exclusivity.
People. Exactly. Yeah. And so when you start going through all of these different private equity investments, by the time any of these private equity investments get to Joe average Main Street investor,
right?
Think of the number of people that have already said no to that investment.
Yeah.
No to that opportunity.
Think of all the seats on the airplane that you had to walk past because they're taken.
Exactly. Exactly. Those investments were already picked through probably and deemed, I don't want to say unworthy, but better opportunities were available to them.
Okay, I think unworthy is appropriate. It's not a good enough investment that the people who have real big assets are willing to put their money in it. And remember, they can afford a higher level of risk.
Yes. And that doesn't mean necessarily that those are bad investments or they won't turn out to be really good investments one day. But on the surface, at that time, when they became available to you, the Joe Q public, okay, those investments were not deemed worthy by the people that have the most amount of money to invest in those types of things. Okay? So that's very, very important to remember because you're not getting the cream of the crop here. By the time you get to the funds that are available in your 401k, whenever that may happen, if it ever happens, right. I don't think personally that it should because I don't think most people truly understand the risks associated with most of these types of funds. But by the time you get those funds into a 401k, those are not going to the venture capitalists. Those are not going to the early adopters. Those are not going to the early stage investors. if it's going to the Main Street public, it's a Main Street investor, it's just not going to be as attractive as an opportunity.
Yep. I was thinking when we were talking about this subject before we started recording, one of the conversations that we have with clients all the time when they leave their company is that they should always roll over their 401k into an IRA, right? Now, there's a lot of reasons why you would want to do that, but the biggest reason, in my opinion, is because of the diversity of assets or investments that you can put into the IRA. 401ks are limited on the number of assets, or investments that you can use. So if you pull up just the average 401k, you're going to find somewhere between 20 and 50 mutual funds to pick from. And at least half of those are target date funds.
50 is really,
that's
really
a big
high.
one, right?
Yeah.
At least half of those are target date funds, which is that one where you put everything into that one fund and it gets more conservative as time passes by. Why? Why did they limit the average 401k holder to so few investments? It's because they know that the average 401k holder is not employing somebody who goes in and researches all this stuff to figure out the right thing. They're just picking a handful of funds, maybe, right? They're picking the one or two or three that had the biggest returns over the last year, and they're saying, that's what I want. And then they leave it alone, and they probably don't rebalance it for years or decades in some cases. If they put lots of volatility, lots of crazy stuff in there, people will shoot themselves in the foot and they won't even realize it. Mm-hmm. So they limit the number of things to protect the consumer from the consumer, right? Putting these kind of investments, the private equity investments, into that is the opposite train of thought. It's opening up the whole world to what you can put into a 401k. And for the average investor, that is a very, very dangerous play.
I hate to use the term dumb down.
But that's exactly what it is.
Because it kind of, there's a connotation there. But at the end of the day, that's what they're trying to do. They're trying to dumb down the lineup of investments that are available to, kind of the Main Street investor in these 401ks, mm-hmm. because everybody within a company has access to this 401k. Right. Everybody from, the person fresh out of college, this is their first job they've ever had, to everyone in the mailroom, to everybody in the operations, all the way up to the C-suite level executives. Right. Okay? Not to sound, I certainly don't want to sound classist or anything when I say this, but those C-suite executives are going to have probably far more information or far more knowledge around investments, and they would be in a far better position to be able to pick and choose the types of investments that they want. Mm-hmm. Plus, they can afford to take on the risk. When you talk about that mail clerk who's just now trying to start investing in their 401k for the first time, they're going to be taking an enormously outsized amount of risk in their portfolio, in whatever small amount of portfolio that they have, if they were to try to throw it all onto these private equity investments, trying to hit some type of a grand slam. Right. Because that's ultimately what you would see people trying to do, is just trying to hit grand slams and a lot of times striking out. Yeah.
So I think, we've been kind of beating on this horse for a while. Kind of just to summarize it a little bit. Private equity is attractive because of the potential upside, but I think most people don't understand the potential downside, and they do not understand the liquidity issues with it. The reason why the current administration would want to push this, and I'm not picking on them, there's other administrations who would probably want this as well. The reason that they would want to do this is because it makes Joe Average out there potentially have a bigger 401k, which, by the way, means a bigger tax bill when they get into their 70s and the RMDs hit. That's another story. But it also gets more investment into companies, innovative companies in many cases, which will grow the economy as a whole. That's great on a macro level, but you as the individual investor can't think like that. You can help out the whole by damaging yourself. That's not a good thing for the individual or for the family. So that's the reason I think we're not big fans. It's just too complex, too difficult to work with, and too much risk. Why take on risk? Remember what Warren Buffett's rule number one is? Don't lose money, right? And this one just has too much of a violation of that principle in there.
Mm-hmm. So moving on. Let's move on to crypto.
Everybody loves crypto now, right?
Yeah, well, it's all over the news. And what's always amazing to me about crypto, whether you're, dyed-in-the-wool huge fan or not, mm-hmm. it's amazing to me the amount of headlines that crypto gets relative to its actual implementation.
Yeah.
The actual implementation, and I don't have exact numbers, but every time you see the amount of implementation within the general public, the number of people in the public sphere that actually own crypto or Bitcoin, it's tiny. It's not very big at all. The adoption levels are still really, really low. Now, to the Bitcoin investor, that they're going to say, well,
That's a good thing.
that's why you need to get in. You can still get in early. And okay, maybe not. Let's talk about why we don't use Bitcoin or crypto anywhere within any of our portfolios as an asset class.
Okay.
Reasonable minds can disagree. I know some advisors have started to adopt it. That's not us. That's not
You
going
need to work
be
with
us.
an advisor that you believe in their philosophy.
Yep.
So
And that's not going to be us
Right.
anytime in the near future, right? But at the end of the day, as crypto bumps up and Bitcoin, I'm just going to stick to Bitcoin because that's the most commonly used one, right? Bitcoin just hit all-time highs recently.
yeah, 124 or something like that.
Did it get that high? Yeah.
Something like
and
that.
I know it's back down, so it's off of its all-time highest. It's still above 100,000. It changes every
Right.
second, right? So I don't know what it is, and I probably should have checked to see what it was before we came in. But at the end of the day, as it goes up, it gets more and more press, more and more interest, more and more people trying to continue to buy Bitcoin. What bothers me about Bitcoin is most people, or crypto in general, most people don't even understand what it is.
No, you're absolutely right.
And what the use case is. What are you going to do with your Bitcoin?
I cannot answer that question personally, which is one of the things that spooks me about it.
And really, the only thing that's driving the price of crypto higher is the value that someone else is willing to pay for it. That sounds an awful lot like a pyramid scheme.
Interesting turn of phrase there.
I'm not saying that this is a pyramid scheme, but when you think about a pyramid scheme, the people at the bottom are the the people at the top, they sell
ones who
to the
got
next
in early
level,
and
the ones that got in early and made all the money, and the people below,
it's
right?
a concept called the next fool,
Yeah.
right?
Yeah, and so you're looking at the next full theory, and you just who's the next person that's going to bite into it, and at the end of the day, if this collapses, someone's going to be left holding the bag.
So the reason that you make money on crypto in general, right? And this comes back to with traditional equities, stock-based things. The difference between those and the types of alternatives that we're talking about so far is they create new wealth. That's what companies do. That's the whole point. That's capitalism in a nutshell right there. That is not true with cryptocurrencies, right? The reason that it gains value is because it's being more and more implemented, and therefore the next fool, according to that principle, is willing to pay more for it than what you did, right?
Correct.
But where's the limit? At what point in time does the implementation start slowing down? At what point in time do people say, I'm not willing to spend more money on that than what you did so that you get your money and some profit back? It will eventually happen theoretically, but none of us know when it is. We're making money on Bitcoin right now because there is a next fool right now. At some point in time, that person doesn't exist, and whoever is holding the bag last, the bottom of the pyramid is the way you phrased it, they lose what they put into it because they won't be able to sell it for what they paid for it.
NFTs are a great example.
Yeah.
And NFTs, if you back during the COVID days, if anyone knows what an NFT is, I don't even remember what it stands for.
I don't either.
Because they came up so fast. Non-fungible token. That's what it was.
That's
yes.
it, yeah.
Token, yes. And they became really, really popular there for a hot minute during the meme stock craze and all the COVID stuff that was going on, a few years back.
That's what happens when the whole planet sits there and watches TV all the time.
Yeah. And so non-fungible tokens, basically people were buying digital artwork and digital assets and digital things that there was some code that was embedded into these digital assets, and you were the only one that owned the code, and the code followed you, right, or something. And
I didn't understand how it worked. I was just looking at this going, there's no chance I'm getting in.
Oh, and those things crashed and burned.
Oh my gosh, yes.
Within a year. I mean, and they crashed spectacularly, right? Now that obviously is an extreme example, and I'm not saying that's going to happen with Bitcoin. I don't know. All I know is with Bitcoin, I can't take it out of my wallet, go to the store and buy stuff with it. There's no fungible value to Bitcoin to me other than if I were to buy it, hold it in a wallet, a digital wallet, and then just hope it goes up. because ultimately that's what I'm doing is I'm hoping Bitcoin goes up. I don't know why it would go up. I mean, I can give you all the ideas in the world, all the government spending too much money and the values, the value of the dollar is going to go down, and more and more countries are adopting Bitcoin as a way. Okay, but
for how long?
I'm hoping all of this happens, right? And at the end of the day, it's speculation, not investment.
Good word. Yes, it's speculative.
It's a speculative investment. If you're going to call it an investment, it's a speculative investment. You are speculating on the price of something one day potentially being higher, but there's nothing fungible to make that price go higher or lower. In fairness, there's nothing there driving the cost of Bitcoin. I can't pull up the price of Bitcoin and tell you why it's valued the way that it is. I can't tell you why the price of Bitcoin would rise and fall on any given day or any given year. I don't know, and no one does. And it's funny because I'll hear people, out of one side of their mouth talk about how it's a store of value, and out the other side of their mouth talk about it, all the different adoptions.
I always say, how is it a store of value?
Well, it's clearly not a store of value, because if it was a store of value, that means it can't go down in value. It holds its value. Bitcoin can vary very wildly.
Oh my gosh, yes.
Yeah, and so by definition, if it's as speculative and as volatile in its price, by definition, it is not a store of value. Okay. Now, if you want to invest in it, knowing the risks and understanding that it is a speculative asset, a speculative investment, yeah, by all means, do it.
But it's a buyer beware type of investment. You need to know you could lose what you're investing here.
Yeah. Whereas in comparison to actual traditional investments, if I'm going to invest in a company, or I'm going to invest in the S&P 500, for example, just a basic stock market fund, I know that at the end of the day, there are people behind those investments. There are corporations. There are people behind those corporations that their sole job, their sole focus is to make that company money. They're trying to increase revenue. They're trying to increase profits. They're trying to increase earnings. They're trying to make more money. And if I am a stockholder, if I'm a shareholder in a business, I want people doing that on my behalf. And I can understand clearly how that company or how that business is going to make money. I can see whether or not they are successful in doing that. And if they are not, I have the ability to walk away from my investments at any time without any issue, because they're fully liquid.
We're going down a little bit of the economics rabbit hole here, but what you just described is capitalism. The reason that it works,
capital C, baby,
is amen. The reason that it works is because all of those people at those companies, those which, that stock just represents ownership in a company. All of the people that work there, from the C-suite people, the board of directors, all the way down to that guy in the mailroom who just started last week, their purpose is to do what is in their own best interest.
Not selfishness.
Not selfishness, but
self-interest.
Correct.
Yes.
Self-interest. By doing what is in their own best interest and making the company bigger, more profitable, better, more efficient, blah, 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 everybody wins that's involved, right? That's the difference between the traditional equity-based investment and the speculation that you're talking about. There's nothing in crypto. There's no person who is working to better himself, to buy himself a better home for his family, or whatever the case might be. That's the beauty of the traditional stock, is that it's backed by people who are in their own best interest doing something that benefits you. And that's not true in these types of investments we're looking at.
Yep. So that's well put. And as we kind of move into gold, and allied silver and any other precious metals in there as well that you might want to throw in. But it's kind of the same story. At the end of the day,
it's exactly the same, except it's been around a long time.
That's the difference.
That's the difference.
That's the difference. It's been around a very, very long time. And I always hear, well, gold has never lost its value. False.
Totally
very,
incorrect.
Very false. It's absolutely lost its value before.
It goes up and down just like any other investment does.
Is it as volatile as stocks? No. But if you look at a long enough timeline, it's not generated nearly the same return. And there was something interesting, an analogy I came across from Warren Buffett here recently that I found very, very interesting.
Yeah,
and
read that one, because this is awesome.
And I thought it did a wonderful job of trying to encapsulate or explain why we don't invest in gold traditionally as an asset class, as a traditional investment manager. Not to say that, it has no value. That's not what I'm saying. But this is typically why we don't necessarily believe in the idea of investing in gold. This is from Warren Buffett. So today the world's gold stock is about 215,000 metric tons. If all this gold were melded together, it would form a cube of about 73 feet on each side, about the size of a baseball field. At $4,000 per ounce, gold's price, as I write this, I should have looked it up to see what it is right now. Its value would be about $28 trillion. Okay, so let's call that pile A.
All right.
So pile A is a big pile of gold, all the gold in the world, worth collectively about $28 trillion based on whatever the price was at that time, $4,000 per ounce. Now let's create a pile B costing an equal amount of money, another $28 trillion pile, and we'll fill it up with something different. Okay, so you could buy all U.S. farmland and all assets worth about $3.6 trillion that are producing more than $500 billion in farm products per year. Okay,
keyword there was producing.
Exactly,
Yeah.
And so that's only $3.6 trillion. So we still have a lot of room left, plus the entirety of the 8 largest publicly traded stocks in America.
Okay,
NVIDIA, Apple, Amazon, Google, Tesla, whatever they are right now, right? Which collectively produce hundreds of billions in profit per year. Per year, right? So when you keep going down that rabbit hole, so admittedly, when people a century from now are fearful, right, it's likely that they would still probably want to own gold in some capacity. They may still even rush to gold. However, I'm confident that the $28 trillion current valuation of Pile A will compound over the century at a rate far inferior to that achieved by Pile B. Pile B, once again, all of that farmland, all of those companies, all of that production, all of those people that work for all those companies and work on those farmlands that are incentivized to continue to increase production of all of those different companies and assets, I would much rather invest in that, knowing that there are people's own self-interests that align with making that pile bigger.
And by the way, when we talk about all of those assets produce something, gold doesn't, crypto doesn't. When it gets finished producing that thing, you know what it does? Repeat. It keeps doing it over and over and over. And by the way, the more they do it, the more efficient they get at it. So they produce more of a thing that people want. The reason that production works is because everybody wants what you're producing, or not everybody, but enough people do want what you're producing. And all of the people who are involved in that production all benefit from that. It's the production part here that really makes the biggest difference.
So there's a few more quotes that I found from Warren Buffett about this that I wanted to highlight. So gold has 2 significant shortcomings, being neither of much use nor procreative. So true, gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end. So that was
doesn't get bigger.
That was in his letter to shareholders in 2011. Okay. This is another quote from 2009. I have no views as to where gold will be in the next 5 years, but the one thing I can tell you is it won't do anything between now and then except look at you.
I love Warren Buffett.
So it just kind of sits there, right?
He's got a wonderful sense of humor, doesn't he? Before you go on with that, let's think about this, because I've heard the argument, but gold has been valuable for centuries, for millennia. Well, you just said it a minute ago. It does have some industrial application. We have discovered that really recently, right? It has some technological application. But why is gold valuable historically? Because it's pretty. Because people like to look at it, because it's shiny, because it's heavy, because you can beat it into different shapes and form, primarily jewelry, right? But all of it comes back down to it's pretty.
Yeah.
I love the comment. If you buy an ounce of gold now in 100 years, you know what you got?
An ounce of gold.
Right?
And the only value that ounce of gold possesses is what someone else is willing
Correct.
to pay for that gold.
Right.
And what they perceive. And I'll give you my perception on gold, just a general, because its most common use case is for jewelry. you can go ask my wife. I bought her a really nice engagement ring, and I got her a really nice wedding ring, and I've not bought her any jewelry since.
Yeah.
I don't believe it's a total waste of money to me. I'm way too pragmatic. My wife has put up with it for very long, right? But I told her, I was like, this is I got you a really nice engagement ring. This is your ring, and you're not going to get on.
We have teased in the past that we need to do an episode on how cheap you are. Right?
Well,
that doesn't really apply.
Cheap in certain, no, I'm too functional. I'm too.
Yeah, there it is. You're functional.
I'm too. Yeah.
You're utilitarian.
Yeah. I'm cheap about things. Other things I'm very much not.
I'm the
cheap
same
about.
way. My wife has a nice wedding ring. She has a nice engagement ring. Not outlandish because I couldn't afford it. We were poor, right?
Yeah.
She does have a small wrap. It's full of little diamond, I believe chips is the correct word, because that's what we could afford. I think it was like 5th anniversary. I haven't bought her any jewelry since, with one or two exceptions, because it comes back down to what you were just insinuating there. Why do we like these things? This is vanity. Mm-hmm. You know, when you talk about, okay, I'm going to buy an ounce of gold now, 100 years from now, I'm going to have an ounce of gold, right? Well, that sounds an awful lot like real estate. I'm going to buy 20 acres of land 100 years from now. I'm still going to have 20 acres of land, but I can use that land. Mm-hmm. I can live on it. I can improve it. I can do things to it. I can't do that to gold. Mm-hmm. It is what it is.
Yeah. This is another one. Last quote from Buffett.
Okay.
What motivates most gold purchasers in their belief is that the ranks of the fearful will grow. And indeed, gold is often described as a safe haven investment, meaning that people will flock to it in times of turmoil in order to feel more secure and to balance out other areas of their portfolios. Mm-hmm. And during certain decades, this belief has proven correct. In some cases, that's absolutely correct. But this all goes back to the idea that the only reason people are really moving or going to purchase more gold in bulk is because they are scared. They are fearful.
Yep.
They're fearful of something else that's happening in the traditional stock market. Mm-hmm. And this goes back to kind of not understanding the way that a capitalist economy works. You're going to have periods of uncertainty.
Yeah, exactly.
But you have to withstand that and understand that there are people behind the scenes at every single one of these companies. Everyone likes to think of the stock market as this singular entity. The stock market is just a collection of companies.
Right.
And if you truly believe that every single person at every single one of these companies is going against their own self-interest and sabotaging the value of their companies on purpose, no.
You're talking about hundreds of millions, even billions of people who work for the companies that you're talking about. If there's one or two people who are just imbeciles and are doing something that's not in their own best interest, that's a pretty small fraction, even if they're in positions of power. The reason that it works is because there are so many people who are doing what is in their own best interest because they're trying to improve their lives. They're trying to provide for their families or improve their situations. That's the beauty of it, is that will always work, right? Now, I want to add to something you said just a second ago. During periods of uncertainty, gold makes a lot of sense. I'll give you a lot of credit. Several years ago, and this was 2022, we knew the markets were moving in a negative way. We were due. We had just had 3 unbelievably good years in the stock market, 3 of the best years ever. Mm-hmm. Inflation was starting to spike. The Fed was raising rates like every time you looked up, they were raising the rates again. I looked at it a couple of weeks ago, and they were showing all the different raises over the last 5 years. And man, it was amazing how many times they raised in such a short period of time. That was causing stocks to plummet. We knew it was going to get worse before it got better. And we had an investment committee meeting, and you came out and said, I think we need to move into a gold position, right? Now, you weren't talking about going out and buying a bunch of gold coins and snuffing them away in a safe somewhere and sitting there and protecting them. You were talking about moving into a gold ETF, which we did. And you know what happened? We didn't go down nearly what some other people did, and we recovered much more rapidly. That's how you use gold.
You hate to say it, but 2022 is actually a good year for us because of our portfolios and the way we design them.
And to your credit, it was your idea. It was your call that we needed to put that in there. But that's how you use gold. It is a hedge against short-term problems.
Much like bonds or fixed income
correct.
or any any non-correlated asset to the stock market.
Right.
But we'll go off on that tangent some other episode, right?
If you look at the stock markets, okay, and we'll just take the S&P 500 because that's the most commonly used, broad-based. If you give it time, it always wins. We've had the conversation with people a million times. Go back and find a 10-year period of time. Pick any time frame you want. The S&P 500 is positive, right? Mm-hmm. You can't say that about gold. In fact, the recent all-time highs, the last time that it was this high was 1980. Well, what was going on? And we talked about this on a podcast a couple of weeks ago. What was going on back then? The markets were in turmoil because inflation was so high, right? So people back then were using it as a hedge as well. And it worked well for that purpose. But to just sit on this as a long-term investment, it is not going to work as well as something that has production and something that is serving its own best interest, because it's just a thing.
Now, I will give gold credit for one thing. In comparison to crypto, we use that analogy. If you took all of the gold and melded it together and put it on a baseball field, right?
And it'll fit in the infield, by the way.
Yeah,
it's 60 feet from base to base, is that right?
Yes.
Or 90 feet?
90 feet.
90 feet. So this is a 73 foot. Yeah, this fits in the infield.
So, but at least you can gather all the gold and put it together, right?
Right.
With Bitcoin, it's
You
out
can't.
there. It's out there in
It's
the
in
ether,
the ether, right?
So
At least you could touch gold.
So
right?
at least there's some tangible asset to some degree behind the idea of investing in gold. That's not even necessarily the case with Bitcoin. Mm-hmm. So, whenever, we get the question of why don't we invest in Bitcoin or why don't we invest in crypto? That's why. Because it's highly, highly speculative. It is not an investment. It is a speculation. Okay, and we only stick to traditional we are long-term investors, and long-term investors believe in a capitalist society. Yep. And we believe in the innovation of the American spirit and the innovation of the American people, and
it always wins.
Exactly,
and
the innovation of American company, and we on a long enough timeline, we're always going to kick everyone's butt. To be perfectly frank, that's just the history of the United States of America. Yep. And in order to stop believing that, there's far greater issues at play, and basically the state of the civilization has to change. Yeah. And we're not there yet. I don't think we're nearly as close to it as some people would want us to believe, based upon political, political talk shows and whatever you might find on.
We've had that conversation too before. Just, you want some peace? Stop watching that stuff. Right?
Yep.
Remember, their job is to sell advertising. They've got to be. They've got to try to get people's attention to make you watch.
Yeah. So all that being said, I think that's probably a pretty good place to wrap up our discussion around alternative investments. We've said a lot about them. There is a lot more to say about them, but we're already 50 minutes in, so it's probably a pretty good time to start wrapping things up there, because we need to discuss this Penelope bourbon. And you just poured yourself the second.
Which is something I very rarely do.
So I figure
I poured a little bit more because
I might give me a little more taste.
I already know I love this. I saw this at $80 and grabbed it. I didn't even hesitate because I know how good it is. But let's get your opinion.
So it's interesting.
Mm-hmm. No, it's different. There's no question.
It is a little bit different. I do like it. Orange is on the nose. Mm-hmm. There's definitely some orange flavor.
I do not know how they do that, but it definitely.
And I'm not someone who's going to sit here and come in every week and tell you about I taste hints of this.
Cherries.
That's not me. It's like, do I like it or not? Yeah, I like it. I do like this, but I can detect a little bit of orange, and it's a little bit of a different flavor. Mm-hmm. What's interesting to me about this, I can drink this like water.
Yep.
Which is a little dangerous.
I wish that they would proof this up so that I wouldn't want to drink it as much.
I can drink this like water. Yeah. I get nothing down. But it's interesting because after when I do drink it, I do get the taste that kind of sticks to the roof of your mouth. I do get some chew on it. Oh. But it goes down a little too smooth, honestly.
It's too good. Is that what you're saying?
Too smooth.
Dangerously good.
Yeah. But it is good. But there's no burn. It is like drinking water. Oh. You get all it's all chew. There's nothing there's nothing down the pipe, right? Mm-hmm. So
I did good. Okay. So if you're watching while you were talking a while ago, I put one drop. I was very careful. I had probably ounce and a quarter left in my glass. I put 1 drop in there. Before you do this, you might want to hear it.
Don't do it.
It didn't change anything.
Really?
I put in a second drop, and it actually hurt it. I did not care for that second drop. It took away some of the flavors that I was really enjoying. It truly, there's that D word again, and I've already forgotten it. We were
dilution.
looking for it. It diluted it. Yeah. I didn't like it as much. If this was much higher proof, I think that a drop or two of water might make it better. But this is one of those bourbons. There's a reason why I have taken my original bottle, which has about that much in it, just, not very much. I've taken it to bourbon events and I've said, just begrudgingly, enjoy, because they're never going to do it again. And that's what it's for. Bourbon is for enjoying. And I've had people who have collections in the tens, if not hundreds of thousands of dollars, drink this and go, wow, that's really good. So when I found out that they would re-released it and I saw a bottle, let me tell you how fast I jumped.
I remember because you'd gone to that event with the Penelope guys, right after they had sold, and made a ton of money.
We got to see that and hear them tell the story before they got to go see their wives after the announcement was made. So you talk about a fun night.
Yeah, but I remember tasting, because of that, I remember tasting Penelope before I ever saw it in a store, ever. And I remember thinking, this is delicious, because we did the cask strength.
Once upon a time, on the previous show.
Like a small batch. Yep. And just the regular Penelope, the white label.
They're all good.
They're all good. So I'm a huge fan of the brand. This is the first time I've had this flavor.
Funny story that they did tell us, the original white label. These guys started on such a shoestring budget that the reason that the original white label, it didn't have this very pretty P printed on there. It was just a white sticker. The reason that it was a white label is because they went to Office Depot to buy the stickers, and they printed it on their own little inkjet printer that one of them already had. And they took it to a bottler and they ran it through, and it tasted horrible. And although the bottler swore up and down that they didn't do this, the last thing that the bottler had run was a tequila. And it picked up, apparently they didn't flush the lines correctly well enough or whatever it is. And the original Penelope tastes like tequila. Not good tequila, by the way. It tasted, well, I'm not going to say that on this broadcast. It was bad. And that's how this company got started. It was on a shoestring budget. And that's why it was so cool that 5 years in, keep in mind, COVID happened 5 years in, the world stopped. These guys almost lost everything. They double and triple mortgaged their houses, and they sacrificed everything. And they both had decent incomes. They were not going to be poor. Mm-hmm. And they put it all on the line to sell this product. And when you hear that they sold it for over $100 million, right? That's true Americana. And where I really got impressed with these two guys, and they're actually out of New Jersey of all places, where I really got impressed.
Oh, that's right. I forgot about that.
When they told us, by the way, and this was one of their employees who came up and said, by the way, when they agreed to sell the company, part of the contract was that the two of them got to stay on at, let's just say, pretty high salaries.
Yeah.
Okay, cool, no problem. And the contract mandated that every single employee of theirs stayed on and got a pay raise.
Yeah.
I can get behind guys who treat their employees like that. That is one of the coolest parts of the story, is they didn't just allow it to benefit them. They wanted it to benefit everybody who had worked so hard for those 5 years. And I want this company to continue to do well. I really do.
Wasn't Penelope like the name of one of their daughters or something?
Something like that.
I don't remember.
I mean, Penelope, I remember Penelope. Okay, I'm going to geek out for a minute, but you took some language history. Penelope was the wife of Odysseus in the story of the Odyssey, right? That's the only person I've ever known named Penelope was from that piece of literature. Yeah. I love the name. I remember asking the guy in that meeting, why the big P? Because it's actually a pretty bottle. Mm-hmm. And he said, when we were desperately trying to get our product out there, and they're literally going from bar to bar trying to get the bar manager to put a bottle of it up there, they had to put something up that made it stick out. And everybody has a goofy looking bottle. So they just basically used a wine bottle, and they put a really big P on the front. And it made it stand out. It made people go, what's that? Which, you know what? The rest is history. $100+ million later, right?
I would love to say that I'm above those types of marketing prospects, but usually whenever I go, like if I'm buying wine and for the wife and I, we're gonna have
You're
a bottle of
as guilty
wine.
as me, right?
Hey, which one of these bottles looks prettiest? I don't know. Sometimes you can't tell. So.
I'll kind of wrap up by saying I have never had a Penelope that I did not like.
Yeah,
I am not a big fan of the Architect, but I will tell you that most people love it. It's just not to my palate.
Oh, I forgot about
That's
that.
the Blue Label one. They have a lot of the Cooper series just has a lot of unique types of things where they're really experimenting. Their big thing is that it's a 4-grain, and it is, like I said, 4 grains are always really good or really bad. There's no gray area. I've yet to have one of theirs that was not really, really good. So if you've never tried Penelope, you need to go out and try it. My favorite that's readily available, look for the red label. That's just the cast strength. That's the one that we did on the show several years back. You're not going to miss with Penelope.
Yep. Good call on the alternative bourbon for a discussion about alternative investments. So it's probably a pretty good place to wrap up. Thanks for joining us. If you have any questions about any of your alternative investments that you may have, or just questions about retirement or investments in general, please go to the show notes, go to our website, give us a call, schedule an appointment. We would love to chat with you in a little bit more detail about your specific situation. Thank you for joining us once again, and we will see you next time.